Hi, this is Chris German. Welcome back to the Apartment Dealer Show. Today I want to do a little something different. I want to take you to highlights of our most recent Apartment Owners Educational Luncheon. Now let me stop right there. When I say highlights, do not mistake this for an ad reel or that there's no real meat contained in this video. What I told my staff to do is basically extricate the main talking points from this last event, real meat. If you could not be at the event and you needed to know everything there was to know within 20 minutes, let's put that together. That's what this video is all about. And for those of you that have never attended our event, it is our flagship event. We hold it twice a year, typically once in the spring, once in the fall. And this video will give you a flavor of who's involved, who are the speakers, what are the topics we cover. This time around, we covered everything from changes in the real estate tax code, the direction of the real estate market given inflation, interest rates, pending recession, how not to get sued as a landlord, what to do about the eviction moratoriums that continue on, and everything in between. I know that you'll find this video insightful. And again, we hope to see you at our next educational event. With that, let's jump there now. Now, having been involved in more than 300 multifamily transactions, and my wife and I being investors ourselves, what I can tell you is that multifamily investments done wrong, what that's going to equate to is stress on your money, a stress on your personal time, and just will rob you of your peace of mind. If done correctly, what multifamily properties should do is provide significant cash flow today, grow your wealth over time, and build for you and then your heirs a financial legacy. And if any of you have been to our educational events, watch our videos, you know that I talk about this financial legacy.
About evictions for anything other than non-payment of rent. Depending on where your property is located, that moratorium will control what you can and cannot do. To make it easy for everybody to understand, anywhere outside of LA County, other than the extension of 2179, which really won't impact you anyway in most cases, but anywhere outside of LA County, there's no issues filing evictions. LA County, and locally, it's LA County that is the most difficult jurisdiction to file the evictions in. So let's put that aside. Let's talk about LA County. Filing the evictions for anything other than non-payment of rent basically goes like this. What can you file an eviction for? Yes, you can file for non-payment of rent. We'll talk about LA City in a second. Completely separate right now. But LA County, yes, you can file for non-payment of rent. You can file for breach of contract that has nothing to do with non-payment of rent. So, for example, if you have a fire lane and your lease says no parking in the fire lane and they consistently park in the fire lane, that would be a perfectly acceptable eviction. What you cannot evict for in most cases is unauthorized occupants, unauthorized animals, and what we call owner-occupied evictions or no-fault evictions. LA County, once July 1st hits, assuming they do not extend AB 2179 again, and I don't think they will, but assuming they don't, as of July 1st, LA County's moratorium will go back into effect. All right, it will control again. The question will be, what does that mean? What will LA County do as of July 1st? And right now we don't know. There's a couple things they could do. They can either pick up right on July 1st where their January 26th moratorium said they would be, or they could easily look up and say, hey, we're just going to start from the April 1st deadline and move that to July 1st and start it right there. If they do that, you're looking at another 18 months of moratoriums in LA County. There's a big misunderstanding out there. I know the moratoriums all say, hey, you can't file an eviction, you can't terminate a tenancy for unauthorized occupants, unauthorized animals, and nuisance. That's not accurate. You can, and we do it every day. In fact, we do a lot of nuisance cases. The nuance to the nuisance cases is LA County's moratorium specifically, I think it's LA County, I might be reversing it with LA City. One of them specifically says, in relation to COVID. So if you've got unauthorized occupants that are in relation to COVID, I'll explain that in a second, you can't file the eviction. If you've got unauthorized animals that are in relation to COVID, you can't file the eviction. If you've got a nuisance that's in relation to COVID, you can't file the eviction. But if they're not related to COVID, you can. So let me walk you through those three scenarios real quick. Unauthorized occupants in relation to COVID. Let's say I'm your tenant, and I'm fine. I wasn't impacted by COVID, but my brother lost his job, and so I let him move in with me. He's an unauthorized occupant, and he moved in because he lost his job because of COVID. That's an unauthorized occupant in relation to COVID. Now, guess what he did? Guess who came with him? His pit bull. It's always a pit bull. So he brought his pit bull with him, and now you have Mike Brennan, who's a legitimate tenant, who was not impacted by COVID, but he's got his brother in there who brought his pit bull. That's in relation to COVID. You cannot do an eviction on that. Guess what else? Mike's brother really likes to party. And on every single Thursday, Friday, and Saturday night, he's out there at the pool having a huge party, blasting the stereo, his pit bull's running all over the place, and every one of your good rent-paying tenants is complaining to you, I'm going to move if you don't get rid of this guy. That is a nuisance in connection to COVID because I'm there, or my brother's there with his dog in connection to COVID, okay? What is not in connection to COVID? People who brought dogs in that did not need, that weren't impacted by COVID. People who have brought in unauthorized occupants where they are not there because of COVID. Yes, we have these situations all the time. I will tell you, we had a situation in Santa Monica. An individual vacated their unit entirely and started Airbnb-ing it. And we've served a notice, and the city attorney of Santa Monica reached out to us and said, hey, you can't serve this notice, unauthorized occupants, in relation to COVID. We wrote him back and said, no, sorry, that's not who this is designed to protect. You can't vacate your unit and start Airbnb-ing it and then fall under the COVID protections. City attorney wrote us a letter and said, we agree. We did the research, you're absolutely right. You can move forward with those evictions. So even though the moratoriums give you categories of evictions you cannot do, that doesn't mean you can't do evictions. It doesn't mean it's a blanket statement that prevents you from doing all these evictions.
If you manage your own properties and you've tried to figure out creative ways to not only pay yourself a certain amount, but maybe start a retirement fund for yourself, maybe put your children on payroll and defer some money into retirement plans for them. Probably one of the most common scenarios is if you have built up your real estate portfolio over your lifetime, and let's say that your real estate asset portfolio is well above the estate exemption. Let's just use a number right now, $12.3 million. Let's say you're well above that. You're not married, filing joint, you're single, you've got a value over that amount. All of a sudden, you start to play a different game in life, tax-wise. Because the federal government says, hey, if you have an estate value over a certain amount, when you die, not only do you have to pay an estate tax on all of that amount, but then your children probably will have some sort of tax liabilities on the back end as well. So people tend to liquidate their assets before death to get themselves below this $12.3 million, or the number changes every year, but about $12 million. The threshold to incorporate, at least what I've come up with over 17 years of working with Robert Hall, is at about $45,000 to $50,000 of net profit, self-employed net profit, property management income, real estate commission income, other consulting income. And that's not a whole lot of money, right? But where did I come up with that number? Well, we figured that if you are at least consistently hitting $45,000 to $50,000 in net profit, incorporating as a subchapter S corporation actually saves you more than it costs you on a year-to-year basis. And that's all that really matters to me, tax-wise, is that it's going to save you more than it costs you. And on top of that, we are achieving great asset protection benefit under an incorporated entity.
So what's interesting about the outcome is in 1980 to 1984, we had a lot of negative charts. Remember, we had supply of inventory over 20 months. We had 10% unemployment. We had interest rates that were 15%. How do you go through all of that and you have no median price damage at all during that cycle? That would surprise you if you looked at it today. In the 90s, 1990 to 96, we had some price damage. Gradual price damage over 5 or 6 years went down about 10%. And everything about the charts in the 90s were better than the charts in the 80s. Interest rates weren't 14 or 15. They were less than 10. Okay? And then we had the crash that we all just lived through not too long ago, historically. Prices crashed, and we had some pretty good charts. We had good interest rates and so forth. So why the different reaction? And that's what's really important, is to see what's next for us. So in the 80s, this is a really important chart, is the ratio of trustee sales. So this is the 80s, and in the 80s, the trustee sales maxed out a little over 25%, meaning 1 in 4 comps was an REO. If you're an appraiser and you're out in the field and 1 of 4 comps shows up as an REO, can you say that is not the market and concentrate on the other sales? And I think the answer is yes, you can, because it isn't the market. It doesn't dominate what you can get for your property. The next cycle in the 90s, it got almost to 40%. So now 4 of 10 comps at the end of that cycle were true. Now you're an appraiser. Does that matter? You can say, yeah, it's closing in on half of the story. So yeah, I'm going to have to acknowledge that comp could affect what you're going to get for your property. In 2008, look at that chart. It became 70%. 7 of 10 sales was an REO. I'll give you a real example. Moreno Valley house that sold 2 years before for $365. We bought for $64. Just 1 digit off, that was all. 64 grand, we fixed it for 20, we put it up for sale. 125 grand asking price. 25 offers in the first day for full price or more. The appraisal came in at 95. Now, why was that? Because 7 out of 10 sales were an REO that was listed for 75 grand. And the appraiser could not ignore that because that was the market he was seeing. So it's real important to understand how important the number of foreclosures are into the outcome of what we are about to experience. So this is the median price journey. All of these people have tremendous equity, and we did something different this time. We didn't extract it. This is the chart. Look what happened in 2002 to 2007. That's your residents and saying, that's a piggy bank, man. Let's go play. That was a big deal. And that's why so many people got upside down, because they had so much debt against the property. You also had lending world that was different. So in front of an audience of 300 or 400 people, we asked this question to a lender. And I was really curious. I said, stated income loans, where does that number come from? She said, oh, we just make it up. Can you imagine being so casual about lending that you say that in front of an audience of hundreds of people? We commit fraud on every loan, and it doesn't matter this year. Isn't that great? Well, that's when you realize you have an unrealistic price. That didn't happen this time. So we don't have phony loans in place. We have tremendous low-interest loans that are fixed, that people really qualified, and then they left their equity in place. So what would happen if you actually had to foreclose on somebody? It's going to go to a sale, but it's not going to revert to an REO. It's going to get bought by a third-party bidder. And guess what the law says now that the state of California can do? They can step in and take the home at the bid amount. So what are the chances you're going to have a pile of REOs to beat up the private sector this time? Very little.
Maybe said differently, for those of you who were caught flat-footed with the passage of rent control, how do we gain back the lost ground? Just waiting and sitting for a tenant to move out, I don't think is the best program if your rental rates, current rental rates, say are $500, $600 below market. And we're going to go through the rental rates. But in the rent control bill, they gave us this beautiful term, substantial remodel. This is your way around rent control, if you will. Unless you own in LA City, sorry. So, substantial improvement. Bottom line, you can give your tenant a 60-day notice to vacate. The second month of that 60 days, they get to live there free. You have to allow them to live the second month free. And then they give you back your rental unit. No more monies have to be given to the tenant. Once they vacate, what you have agreed to is that you're going to do a substantial improvement. Now, substantial improvement doesn't mean you paint the kitchen and paint the bathroom, okay? And in the law itself, they actually outline that if you do things like replumb a building, new plumbing, new electrical, something that would take longer than 30 days is how the timeline they built into it, okay? And that would cause you to pull permit, not that you have to pull permit, but that would cause you to pull permit. Some cities actually now are requiring you to pull permit because they've caught on to this. Maybe they saw my YouTube video, I don't know. But some cities now, they actually require you to pull the permit. But most areas you don't. And so you can ask the tenant to vacate. But again, this takes an analysis. What's your current rent versus the market? And we're going to look at the market rents. And I'm telling you, if you do the correct type of substantial improvement, use good finish materials, you're going to get 15, 20% above market rents when you're done with that property, because we continue to do it time and time again. How we're able to do that is we go after a particular type of tenant. The type of tenant that we're looking for is not a tenant that's looking for affordability. That's the wrong tenant. You're looking for a tenant who's looking for what I would call livability. This tenant that we have in mind is a millennial. Now, we've been talking about millennials for about the past 4 years here at our educational events that, number one, they're the largest segment of the population, even larger than the baby boomers. So there's just more of them, so your units should be marketable to them. Not only are there more of them, but they typically cohabitate, put marriage off, put having children off, and what that really means is they have more discretionary income. More discretionary income of which to pay you and I rent. And these individuals, because they've made the decision that they're not necessarily interested in buying a single-family house or can't afford it, are willing to overpay. And this is the biggest makeup of my tenant base in the buildings that my wife and I own. They're willing to overpay, oftentimes 15, 20% above market, but you have to have the right type of unit that's marketable to them. So, a couple years ago, somebody said, well, Chris, this all sounds great, but it wouldn't work in my city. It wouldn't work here, it wouldn't work there. So we put it to the test.
So a liquidated damages clause applies to a sale of real estate, and you've seen it, and here's what it means. If a buyer agrees to buy a property, and the buyer is then obligated to buy the property because the buyer removed all their contingencies, and then the buyer breaches the contract, so the buyer fails through no fault of the seller to close escrow on time. I'll say that again. Where the buyer has removed all their contingencies, the buyer is therefore obligated to purchase, and then through no fault of the seller fails to close escrow on time, now the buyer has breached the contract. The seller would be allowed to collect their actual damages. Whatever the seller can prove that they lost, that's what they'd get. So if the seller sold the property for $2 million and the buyer breaches because we went into a recession and they couldn't perform, and then the seller, instead of selling for $2 million, has to sell for $1.8 million, the seller can recover $200,000. And there are other things they can recover, but the $200,000. If, on the other hand, you're in a rising market and the buyer agrees to buy for $2 million and the seller can then turn around and sell for $2.2 million, the seller has suffered no damages and so is entitled to recover nothing. But what you can do when you enter into a real estate contract is you can agree to liquidate the damages. In other words, the seller won't have to prove what they lost. They'll get the liquidated damages if the buyer breached. And the seller won't be able to get more because we liquidated the damages. And so that's the purpose of a liquidated damages clause. It's to be used wherever it is impossible or difficult to ascertain the actual damages that the seller suffered. We liquidate them so that all the seller has to prove is that the buyer breached. Again, buyer breach meaning buyer removed all their contingencies and then through no fault of the seller failed to close on time. If you own your property in an LLC and something goes wrong and it's not insured and something goes terribly wrong and you lose that property, you lose that property. But it's like a watertight door on a ship. You don't lose your house, you don't lose your other investments, you don't lose your stocks and bonds, you don't lose your business. It's a watertight door. It's a liability shield. There are conditions under which it can be pierced and fail, but that's only when you do something wrong. you commingle funds, you pay personal expenses out of the LLC, you mix money up, you treat it as your own piggy bank, then the court won't hold it up either. The court says that if you don't show respect for the LLC, neither will they. IRS says the same thing. So generally, you want to own your properties in an LLC.
So we're going to take some questions that were submitted both at the time of registration, those that have been submitted here at the event. But this is listed many times here, and so we'll address the elephant in the room. Are the financial and real estate markets in a bubble?
Speaking of a bubble, I wouldn't say our real estate's in a bubble. What we have to watch out for, which is beyond my pay grade, is a global debt bubble. That is not debt servicing. And the idea is they're trying to inflate with cheaper dollars to pay that debt. So if that strategy works, the bubble doesn't pop.
No government in history has had the sort of debt that we have today and survived without inflating their way out of it. Our government cannot possibly pay the debt. They have to inflate out of it. So this inflation will be permitted because it will save the government. It's going to crush the middle class and the lower class, but the people who own assets, the asset class, whether it's stocks and bonds or in particular real estate, which is particularly inflation resistant, the inflation is going to be difficult to bring under control because not everybody wants it brought under control.
With respect to a refinance, Gil, obviously rates are going up. So someone's sitting on a loan, the fixed period is coming to an end, so they say, hey, you know what, I need to refinance now. Should they take out cash? This question is, should they take out cash if they don't have a building to buy? They don't have something in mind. So now the money is just sitting there while inflation is going up, and thus the money's losing buying power.
Well, when I said rates are going to come down, I meant immediate and short term, not a long-term trend. I just want to make that clear. We're in a long-term bull trend that we can go to treasuries all the way to 7%. So keep that in mind. I meant a window of opportunity. It might be the window for you to refinance the last time in the threes. So that's very relative. Now, knowing that I just said that we're going to be maybe the last window for threes, would I take cash out? Absolutely, I would. Now, would you have a game plan to be aggressive with that and play offense? That's what this whole seminar is about, is playing offense. Improve your asset, sell your asset, redo it. Do something to the asset to do what? Increase your rents. Get over market. Any tenant that pays over market is not going to have a problem. I mean, or less problems, right? So get over market. That is the key. I mean, Chris has shown you with his numbers. So you can improve your asset, increase those rents, take the money out, use the money. Remember, you don't want to go through this again. Most commercial loans have, prepays, so you don't want to go through this again. And chances of you seeing these rates in the threes again are pretty dim.
Best guess, Gil, when does that lower window begin? About when does it end?
Well, right now we hit 296, I believe, and the market broke down to 277, which is 20 bips. So the market dropped instantly at that barrier. If the market is able to go to 3.25 and break 3.25, we're headed up. So that window that I mentioned will not exist at all. What I see is this window could be started now, as soon as now, and I see a bottom somewhere around 210 on a 10-year treasury.
There is no wrong time to sell or buy real estate. There are wrong ways to sell or buy real estate. If you buy real estate, make sure you can afford to hold on during the tough times, because the greatest fortunes in real estate are made by those who can hold on during the tough times. So proper leverage, not too much leverage, being able to manage the properties, this is key. Second thing, be good landlords. If you have a tenant who has a complaint, address it promptly, cheerfully. Your tenants are not your subordinates. They are not the enemy. They're your customers. And you want them to feel well about the place they live. You want the community you're creating, whether it's 2 units or 200 units, you want that community to be their home, not just their house. You want them to care about the property. And if you care about the property, they have a higher probability of caring about the property. Be good landlords. Fix things. Don't cheap out, spend the money, improve the property, save the property, preserve the property, and keep the tenants happy. The clients who we have who do that just don't get sued.